Hi, welcome to the Interaxis YouTube channel and Interaxis.io. Today I want to talk about a report that came out last week from a company called Bitwise. And what Bitwise is they're an asset manager. They have funds that are available right now for accredited investors that invest in cryptocurrency. But Bitwise went out and did a study, a very in-depth study report, and looked at the impact on your portfolio or on a portfolio of allocating a small bit to just Bitcoin, not other cryptocurrencies, just Bitcoin, to go back and study and see what would happen. And the results were pretty interesting. Obviously, as we would think, based on the growth of Bitcoin back from 2014, back when they started the studying, back when they started looking at the statistics, obviously, as you would expect, it would have an impressive positive impact. But then going into some of the nuances of the study has even more interesting effects, and I really wanted to go into those. So first, what we'll talk about is what Bitwise did in this particular study. Is they took a particular, a typical 60-40 portfolio. What that means is 60% equity, so this is stocks, funds, that kind of thing, things that invest in equities, and fixed. So this is bonds and such. This is fixed incomes. This is paying you basically an interest rate or what it looks like when we invest in something that doesn't have a whole lot of risk to it. So this is risk. This is pretty much non-risk, a 60-40 split. That's what we talk about in financial planning and in investment management terms, 60-40, 70-30, 80-20. This is a 60-40. So they took a 60-40 and they said, instead of part of the 60, we're basically going to we're going to add anywhere from 1 to 5% Bitcoin instead of the 60. And that's where this report is, and that's why some of the findings are relatively interesting. So, a little bit about what some of these findings were, and we're going to explain them a little bit. So one, they went back to 2014. Okay, and so you have your 60-40 split Bitcoin, and they did 1% Bitcoin, 2.5% Bitcoin, and 5% Bitcoin instead of the 60. And here's what we find. No allocation to Bitcoin gets you about a 26% rate of return. Now, this is as of March 31st of this year. So this is after all equities just fell off the table this year. March 31st of 2020. After that, going back to 2014, your portfolio will be up about 26%. If you had the 1% allocation to Bitcoin, it would be about 33%. The 2.5% allocation to Bitcoin is about 45%. And the 5%, you're up about 65%. Okay, so that's what this is saying is, if I allocate 1% of my portfolio to Bitcoin, 59% to equities, and 40% fixed income, I have a difference in growth from 26 to 33. How does that translate into real numbers? Let's say I invest $10,000, okay, in all these portfolios. This one would be worth $12,600 at the end of this time. This one would be worth $13,330, $14,500, $16,500. Okay, that's how those numbers play out had I invested $10,000 at the beginning in total. So quite a swing from just investing 5% in Bitcoin, almost a $4,000, a $3,900 difference over that period of time. Now, what you might say, and what the people at Bitwise rightly said is, okay, that's not really fair, because Bitcoin at the beginning at 2014 was worth like $750. And even after the big run up in Bitcoin in 2017 and way back down and back up and down and up and down, Bitcoin was worth over $6,000, $6,500 or $7,000 or something like that on March 31st of 2020. So that's not really fair. You're taking an asset that was worth $750 in 2014 that very few people knew about, and saying, what if you had the foresight to invest in it at that point? And trying to take that and say, this is why you should invest in Bitcoin now. You might go, well, that seems silly. It's already run up to wherever it is today, which is around $9,000. I don't see that kind of growth, so that doesn't really pertain to me. So the people at Bitwise said, we totally see that, because that's not really fair to go all the way back to 2014 and look at it, because obviously you're going to have some crazy numbers because Bitcoin has had such a big run. So here's what they did. They went to December of 2017. Now, December of 2017 was pretty much the peak of Bitcoin. This is like $20,000 Bitcoin. This is as high as it's ever been. And they said, what if you allocated that same 1, 2.5, 5% to Bitcoin, or 0% to Bitcoin? And most investors will go, well, surely you're going to be worse over here than you are in this 0%, right? Now, what you also have to think about is you need to rebalance a portfolio. And this is why some of this study is actually eye-opening, not just for using Bitcoin, but eye-opening in how rebalancing a portfolio and using what's called non-correlated assets is such a big deal. So first I'm going to talk about the study, and then I'm going to talk about a little bit about non-correlated and what that means. Okay, so what this found was, if I go back here, going from December of 2017, if I do a regular 60-40 portfolio till March 31st of this year, I have a negative 0.54% return. I'm basically even. Okay, because remember we had this huge run up until late February of this year, and then we just dropped, right? The equities markets, granted, the Bitcoin dropped as well. This is 0.51% negative. This is 0.05% positive, and this was 0.4% positive. Okay, so there is still a positive impact. Buying Bitcoin at its absolute peak with 5% of your portfolio and having it go from near $20,000 at that point until March of this year at under $7,000, you still had better gains than you would in a 60-40 portfolio. Why? How can that be? And the answer is because of rebalancing and non-correlation. And it's really important to see that here. So what is rebalancing? Rebalancing says that, and regular rebalancing tells us that, let's say we're doing it quarterly. So we have, of our $10,000, right, and I'll go with the 5% example because it makes the math in my head much easier, right? So we have $10,000. Okay, so we're going to allocate 5% to Bitcoin, right? So what is it? $500 to Bitcoin. We're going to allocate 40%, so $4,000 to fixed income, and we're going to allocate the other $5,500 to equities. Okay, so that's how it looks when it starts. So this is equity, Bitcoin, and funds. Now, as these go up and down like this, right, like the market does, every quarter you're going to rebalance to get back to these percentages, right? So if Bitcoin at one point goes up to 1,000, if your Bitcoin goes up to 1,000 and this goes down to 5,000, at the end of the quarter you're going to rebalance to get everything back in alignment. So where you have 5, 55, 40%. Okay, so at the end of a quarter, if this was 8%, 52%, and 40%, right? You're going to rebalance those two. You're going to sell some of this and buy some of this. If at the end of the next quarter, this was 3%, 56%, and 41%, you're going to rebalance things to get them back in order. And what that means is you're selling something that you made money on and you're buying something that's gone down. And hopefully as they move, you're always making money on something, selling it, and buying something at a low. And the idea is you'll be better off if those things are non-correlated. And what we saw was that is actually the case. Even with Bitcoin going all the way from almost $20,000 down to under $7,000, it still helped to have something non-correlated. What does non-correlated mean? So I hope this example is stark enough to see this, because that is incredibly eye-opening to have an asset like that in your portfolio, and as long as you rebalance, it still helped you out. So what does non-correlated mean? It means that as the stock market, for instance, is doing this, Bitcoin can be doing this. It doesn't, one has very little effect on the other. That's what non-correlated means. We see it a lot in real estate. We see it a lot in oil, for instance. Gold, not so much. But Bitcoin, in this case, real estate a lot of times is non-correlated. That means it doesn't necessarily matter what's happening in the stock market. Bitcoin's going to do its thing. The stock market's going to do its thing. So why is that important? What it means is that as long as you're rebalancing, okay, again, and Bitcoin did this and that, right? Or not that so much, but that, right? And at the same time, the stock market was doing this, okay? So look at the difference in these charts. This is non-correlated. It doesn't really matter what's happening in the stock market. Bitcoin's going to do something different. So at the end of a quarter, if this is the end of a quarter, you might be selling this and buying this, and then this goes up and you sell this and you might be buying this, okay? So you're always going to get something that's going up. That's the important, that's non-correlation. Now, a lot of people confuse non-correlated with negatively correlated. So negatively correlated would be if the stock market's doing this and you have some asset that's doing this, that is negatively correlated. And if this is going up, this is going down. Gold, it isn't exactly, but gold tends to be somewhat negatively correlated to the stock market. And the reason is because people might, if they think the stock market's going to go down, they want to hold it somewhere and they hold their money, they hold their wealth in gold at that time. So it tends to be negative, more negatively correlated, meaning it's a negative one for one. Bitcoin, on the other hand, tends to be not really correlated at all to the stock market. And that's really important when we see this rebalancing. It's really, and that's what was so stark about this study. The other thing we found from this study, which is really interesting, is we talk about something called drawdown. Okay, and drawdown pertains to how much, what's the most or the average or the biggest drawdown from this peak to this trough. How much did I lose in value from this peak to this trough, from this peak to this trough? What percentage did I lose in value? And we try to limit the max drawdown, because the max drawdown is, okay, what if I have my money here and it comes down to here and I have to pull money out? I don't want to have to pull my money out of this account when it's down, 30%. Right? So I try to limit what my max drawdown is. The drawdown is equivalent to essentially volatility. And I don't necessarily want all that volatility if I might need that money. Now, if I'm a super long-term investor, if I'm looking out 30 years, I might not care quite as much. But in the short term, I might really care about volatility or drawdown. We really look at it for people that are at or close to retirement, because if they have to pull money out, if this is their 401k money, their retirement money, and they're going to use it to fund their life, we don't want a huge drawdown here, because they're going to have to pull their money out at a time when it's at a low, and we're not giving it a chance to come back up. And as we've seen, the market has come back up. So we really try to limit the drawdown. Now, what we found was, when looking at when to potentially make this rebalance, whether it's you buy Bitcoin and you just hold it for good no matter how much you buy, or you rebalance annually, or you rebalance quarterly or monthly, we found an interesting impact on the drawdown. So if you had, going back to 2014, right, if you had bought Bitcoin at say 2.5% in this portfolio and never rebalanced it, okay, your max drawdown was actually pretty high. It was 32% in your whole portfolio at one point. So again, 2.5% allocated to Bitcoin, and no reallocation, no rebalancing. Your max drawdown was about 32%. Okay, if you rebalanced at all, annually, quarterly, monthly, doesn't really matter, it brings this drawdown to about 22%. So again, the advocacy here is not even necessarily go put Bitcoin in your portfolio, because again, looking at past results doesn't guarantee any sort of future returns. What it speaks to is finding some sort of non-correlated asset, putting it in your portfolio, and rebalancing continuously. Look at what a huge difference this makes. Your max drawdown goes from 32% to 22%. Even on an asset, on Bitcoin, if you bought it at its absolute peak and you rebalanced quarterly, you still had better performance than if you were just in a 60-40 portfolio. That is such a stark illustration of the need for diversification, some non-correlated assets, and rebalancing. Someone to be looking at your portfolio and making sure that you're rebalancing as I've ever seen. So this was a company called Bitwise that did this report. I'll link to their website, and you can fill in some information and get the report if you'd like. They're a really great company coming out with funds that deal with cryptocurrency, but this report was so interesting, and I really wanted to highlight it, and I was fortunate enough to be on a webinar last week where they were talking about it, and I just wanted to get on here and draw it out and show what some of the real eye-opening parts of that report are. So thanks, Matt Hogan and Hunter and the guys at Bitwise for doing that. It was really interesting, and I hope you enjoyed this video. Don't forget to subscribe to the YouTube channel. If you're a financial advisor or banking or something, financial professional, go to our website, sign up. We have the Interaxis Academy now, where we're teaching you all about cryptocurrency, digital assets, why it'll be important for you in the future, how you can help your clients, how you can make money on understanding, how you can make money by understanding and helping your clients with digital assets now and in the future. So we have our Interaxis Academy. Go sign up for that. It's going to be nonstop content all the time. We already have over 100 lessons in there. Go check that out. Subscribe to the YouTube channel. Again, check us out on Twitter at Interaxis8, and we hope to see you in the next video.